Welcome to the Ronel Talks Money Show. Now, today we are going to talk about a topic that can be quite daunting and something that maybe a lot of people actually want to run away from. But I do believe it is really important that you educate yourself about this topic and that you have sufficient knowledge so that you can make better decisions. And today's topic is all about expat tax, financial and immigration, and also exchange control regulations. Now, before I introduce our guest today, I just want to remind you to please go and subscribe to the YouTube channel so that you can get access to all of the Ronel Talks Money shows. And then also remember, there is a link in the description field where you can enter our monthly giveaway competition, where you can win one of my books, Financially Fit and Wealthy, as well as various other financial online courses. So please go and enter the competition. But today, to tell us more about this daunting topic for many and to help you to understand this a lot better, we have Hugo van Zyl. Now, Hugo is very experienced within the tax world, and he can definitely share a lot of wisdom and knowledge. So Hugo, I know you are in Dubai, so thank you for making time for us today and welcome.
Thank you so much, Ronel, and thank you to the listeners for the time, and the viewers or listeners on YouTube, I never know. But looking forward to just educate, as you say. So that's actually quite we're so used to selling advice, and it's nice to be part of an educational team for a change.
Excellent. Hugo, now maybe you should just kick off by just telling us a little bit more about yourself, your experience, as well as specifically Wegkaner. What do you do?
Okay, so first of all, thank you, Ronel. I'm a chartered accountant by training. And after that, I did a master's degree at the Law Faculty of Pretoria University. So I have a master's degree in tax. So at the time, everybody was doing the postgraduate diploma in tax, and I decided I wanted a master's degree. I think that I was young, and I probably thought of doing a doctorate later, but all that has gone by. But so Wegkaner comes from around 2001. We had Afrikaans festivals or South African festivals in London called Ukasi, from playing on the word occasion in UK, Ukasi. And just after me was two South African well-known lady singers, and they call the people in the audience Wegkaners, away Africans. And I then registered a Twitter handle with that name, and I see one or twice Karen Hougaard has referred again to Wegkaner. And then in 2016-17, when the expat tax came to the front and it became such a topic, I saw some people referring to this Wegkaner thinking it means expat. And I then changed my trading name from Hugo van Zyl to Wegkaner. So Wegkaner is aimed at the expat. So I have a business in South Africa, local tax business, but Wegkaner for the South Africans. But where it all started, very, very interesting story. At the time, very, very sensitive about it, but now in hindsight, we can speak about it. Is right in 1992, 93. I became a partner in an audit firm in 1993, 1st of March. In that March, Chris Hani was killed. My business partner left for America. And he said to me, you can pay me when the Reserve Bank allows you to send out money. So he was my financier. And the person I am, I tried as much as I could to learn how to get money out of the country in a legal way, because we both chartered accountants. I was young, he was much older. But you didn't want to do anything illegal because you can't give advice and then do something stupid. And that's where my experience in exchange control came about, because people ask me, where can one get training on exchange control? Unless you work for a bank, there's no official course in exchange control other than trial and error, hard learning. So yeah, from losing my business partner in 93 when Chris Hani was killed, I went through the cycle of then helping every Afrikaans and Jewish person to leave the country. Came 2003, we had tax and exchange control amnesty to help those South Africans living in South Africa to clear their money. And suddenly my practice changed And that has been my success. And now BEE is a big thing. But then suddenly all my clients was Black South Africans, unfortunately we have to add that color, that was expats in their own right coming back in 1994. And as much as we feared the change, they coming back feared the change. And we had then a lot of South Africans living here, very legal, but they had illegal money abroad or unregulated money. And we cleared that in 2003, which gave a lot of freedom to a lot of people, because you can't be in politics and have this fear someone's going to catch you that you have illegal money. So that is the thing I also want to tell people. If I mention something and you feel you may have done something wrong and it needs to be rectified, the Reserve Bank is approachable. Let's rather rectify, because even the new rules that was announced on the 6th of January, it's a rule going forward. They make it very clear. This is not ratifying past irregularities.
Okay. I think that is such an interesting story, and it's always so interesting to see kind of, or to hear how people, go onto a certain path. And I'm sure kind of now with a lot of people leaving the country, as well as people again coming back, there's certainly, I think, a big need for this type of knowledge and advice out there.
Interesting, yeah. And we sometimes are so guilty. I meet people and I think it's only Afrikaans people or only English people or only Xhosa people leaving the country. Expats is truly as checkered as the country is. It is every South African at every field. And that makes my life in Dubai so interesting at the moment. I'm spending an entire month here because, it's a Sharia law country. So you have some clients that are happy to be in the Sharia law country because they follow Sharia Muslim law. And you have others that are not happy with that. And then suddenly you meet someone that speaks Afrikaans and they say, don't worry, just change the tax issues. We're happy with Sharia law. So you really get educated to just understand and accept that we as a nation in South Africa are just so unique because we've learned to blend and work with each other. And that's very important. People must not think expats are just Afrikaans people who left the country or terrorists that are outside South Africa. It's really, really, truly South African passport holders, all different creeds, nationalities, and religion. So it's really, my day is so interesting. I say to someone, I have so much passion about that because if I have 11 appointments a day, which I do in Dubai at the moment, I literally can guarantee you 11 different stories.
No, I can totally believe that. Now, I think, and this is, and that is, I think, why I invited you, because this is also something that people should rather gain the knowledge before they make, big decisions, so that they don't kind of, in hindsight, like you say, now something is kind of catching them, or, they almost realize that they actually made not the best decision because they were not aware of what's happening and what they need to know. But maybe we should just go back to the basics and just explain to us in layman's terms, what is expat tax exactly, or what does it refer to?
Okay. So in 2001, 1 March 2001, our tax laws changed and we went to what we call the worldwide basis of taxation based on your residency. So most South Africans with a South African ID living in the country were tax resident. So the word tax resident has different meanings. I'm not going to go into the technical side of it, but let's accept that most South Africans living in South Africa on a South African passport is tax resident. Then the minute you go and work offshore, from day one, we had a specific rule that said, if you spend 183 days in any 12 months, it need not be a tax year. And of that 183 days, 60 or more nights must be outside of South Africa consecutively. Then you could claim tax exemption on that part of your foreign earnings, not investment income, just your earnings, but only calculated for those days that you were physically abroad. There's one little exception. If you're physically abroad for an entire year and you come back to South Africa for a 2-week holiday, that's not counted against you. I'm talking about the people sitting in South Africa and their business or employers send them out to a foreign country to second them, typical secondment. So those people could claim a part of their salary tax-free, but the entire foreign earned income was then tax-free. Then they came in 2016 and they told us they want to start taxing it. Initially, it was R1 million exemption. And then now in March this year, eventually the law passed for 1.25 million. So what happens is from 1 March 2020, which is then our February 2021 tax year, the one that ends very soon, it says that every South African tax resident, so that could be a passport holder, it could be a dual national, doesn't matter, it's about your tax residency, can claim 1.25 million rand as tax exempt of your foreign, let's call it salary, but it's the earnings, okay, which means fringe benefits and all those technical things. And suddenly, because the rand is so weak, and for example, here in Dubai, people get a housing allowance up to sometimes a quarter of their salary. And they also get an allowance for their children to be at a better school. So that is taxable. So suddenly when we say to them, that is not your salary of 1.25 million, it's your taxable salary. Now that's another term that becomes complicated, but your cash salary plus the value of the fringe benefits using South African law. And that then always puts them over 1.25 million. And then the tax law says, when you go over 1.25, the rest of that, the excess, is taxed at a sliding scale, not flat 45% as many think. You start at 18% and it goes up. Okay, so that in short is expat tax. But the other part we have to say is that if you are tax non-resident, even if you hold an passport from South Africa, if you're living in a treaty country, or you have left South Africa so permanently that you're no longer ordinarily resident, and you live, for example, in Panama, that's not a treaty country, you can still be then deemed to be not tax resident. So in tax law, we say you ceased to be a resident for tax purposes. Once you're in that status, then you're not subject to expat tax. So the 183/60-day rule is only for people who are South African tax law residents, and it's not necessarily passport holders. It could be a Brit on a work permit or a visa in South Africa.
Mm. Okay, that's really interesting. And tell me, I think some of the other terms that we also hear a lot about currently is financial and tax immigration. So maybe you can also just explain that to us.
Okay. So the tax law uses the word cease to be tax resident. So I started calling that tax migration, and I have a web page called Tax Migration. The other one is to immigrate on the bank platform. So the official word is formal immigration, and another group has started a business solution, which they called financial immigration, and now everybody uses the word financial immigration. But the correct words is then ceasing to be a tax resident and formally immigrating on at the Reserve Bank level. But now, as we every day say, tax migration and financial immigration. So tax migration is purely in terms of the South African Tax Act. It's a relationship between you and the receiver and your accountant. It does not impact on your credit cards. It does not impact on your banking relationship and banking rights in South Africa. Formal immigration, on the other hand, also referred to as financial immigration, then you terminate your banking relationship and you say, I am not coming back for the next at least 5 years. And I'm permanently leaving South Africa because I have a permanent residency permit in another country or a dual nationality. That then created what we call a blocked account. The correct word again is a capital account. It's not that your money is blocked, but you can't no longer actually transact on the internet, log on and do an EFT. You have to phone someone at the bank and say, please pay the dentist for me. Okay. And once you have formally immigrated, the one big difference there is when you are a resident of South Africa for tax, you can take 10 million per person out, but you must first get a tax clearance. If you have formally immigrated, after that, you can do 10 million per person or 20 million as a couple without tax clearance, just automatically. So that was one benefit. The other benefit of financial immigration was that you can take your retirement annuities out, cash it out before you're age 55. And the third benefit was that you could own your South African properties through an offshore trust. You could have taken it out of the South African estate duty. And that's what we call loop structures. So February last year, the minister said he is going to cancel formal immigration. So 28th of February this year is the last day you can apply for financial immigration. So now to make it possible for South Africans who are not going to do financial immigration and only do tax immigration, they can now do loops. So where this loop structure, using an offshore trust to own a property in South Africa was totally illegal, it suddenly became legal on the 6th of January, backdated to the 1st of January. But before people get too excited, already in October last year, they tabled new tax law, which is anti-avoidance rules. So you can't use this loop rules to get your property out of the South African tax net. So don't think you can use these offshore trusts to get outside of the tax net from South Africa, okay? The loops, or the using an offshore entity, is only really meaningful for people where the parents live in South Africa and all their children live outside. So to give you an example, if someone, in the past we said do financial immigration, if the child is living in Australia or all the children, there's no estate duty there. Then they could use the Australian trust to buy the South African farm or holiday home, because then it's not a loop, because they financially immigrated. Now, as of 1 January this year, they don't need to financially immigrate anymore. And obviously from 1 March, they can't financially immigrate. They can still use what the so-called loop. A loop is an offshore structure owning South African property for the benefit of South African, say, passport holders and so on. And interestingly, now that will be legal. So there are a group of people for whom it will be really attractive, living in a country like Australia where there's no estate duty or death duty, and then you don't need to register an estate when your parents die and pay estate duty. You rather pay the capital gains tax now and transfer it into an offshore trust. But tax migration, coming back to that, whether you do financial immigration or tax immigration, in both cases, you have to pay an exit tax. So the taxman says, for you to get out of this expat tax, not to pay tax on that amount above 1.25 million, there's this last stab to get some money out of you. And it's called the exit tax. It's actually a capital gains tax on unrealized gains. So if you have R1 million in the stock exchange, but you inherited it for 500,000, then if you leave South Africa, you must pay the capital gains tax between the value that it was when your parents died, when you inherited, or when you bought it, and the market value the day you left. So it's a tax on unrealized gains. As a general rule, capital gains tax is always after there's a cash flow. So one of the nice things about capital gains tax, there's always cash to pay it. But for an expat, changing his status from resident South African to tax non-resident, he is going to pay tax, and he hasn't really sold, because the Tax Act says you're deemed to have sold it to yourself. Hugo van Zyl, South African, has sold to Hugo van Zyl in Dubai the day before you've changed tax status. So they bring it back into the system that they can collect the tax. Okay,
true. So there's so much that you need to
That's
know
the planning.
about.
That's the planning we need to do. So people who leave the country, so for example, let's make it practical. Now I have someone sitting in Dubai, their tax year that they're going to have to pay this tax is end of February. So they must pay this provisional tax by end of February. And that's a very important topic. If you're working outside of South Africa, or you're working even in South Africa for a foreign employer, then you're always a provisional taxpayer. So South African working for a foreign embassy, often they think they're tax exempt. They're not. They are provisional taxpayers because the embassy does not have to pay tax in South Africa. So now these people have to pay the tax end of February, or we need to seize tax residency and backdate it to the day they arrived here. For some of them, we can take it back to 2016 when the double tax treaty with the UAE came into being. But now we have to calculate that exit tax and pay it. So there's a price to pay for this freedom. If it was in 2016, you have to do what we call voluntary disclosure. You have to go to SARS and say, oops, I forgot. Okay, that's why I'm saying people shouldn't worry that they forgot. There's a way. You're going to pay the interest, but we can get you out of the penalties. But only while SARS does not know about it. You know, this big thing, common reporting standards, I saw that you had one thing on it before, you know, on your links, there's a lot of things, referral to CRS, common reporting standards. That is unfortunately going to disclose you. So the minute you have a foreign bank account, that bank is going to report normally to your tax country or your passport country. So at the moment we get to SARS before they get to us. That's your key. Go and clean it up before they come to you. So a lot of people think because I live abroad, I don't have to do anything because I changed my address at the bank. I've done the what do they call it? Self-declaration for CRS. It's not good enough. That is actually what's going to trigger you at SARS. You now have to complete that process at SARS. And then the other thing, which is very, very complex, When we saw the law and we didn't realize the impact of it, but the Tax Administration Act says SARS can penalize you 21 days after you left South Africa for not updating the records. Because the FICA address, what we think must be a South African address, can be any address anywhere in the world. So your FICA address, if you're not living in South Africa, if you claim that you're non-resident, must be the habitual home address in Dubai, England, Australia, America, wherever.
Mm-hmm. Sure. Now, there's really a lot that people need to consider. I just want to, and I think now with what's happening specifically in South Africa and the impact that lockdown had on many people and the economy, there will definitely, I believe, be like in a bigger move to where people will think, but I need to find a job because so many people are losing their jobs at this stage and say, okay, but let me try and go work abroad. Or maybe I am a business person, my business is struggling here, maybe I should open up a business abroad. What are the differences in terms of tax implications when you go and you work outside of the country as opposed to opening up or starting up a company or a business outside of South Africa?
Africa. Okay. So very important. Let's start with the impact of COVID. So remember we said the days was 183 days in a 12-month period. For the two COVID tax years, which was February 2020 and February 2021. But now our government has only locked us down till 15th of February. So if it goes beyond 15th of February, it's another 30 days and it's going to be in March. But the tax laws only cover us till 28th of February 2021. For the 2020 and 21 tax years, the 183 days was reduced to 117 days. So they deduct the 66 days of lockdown 4 and 5. Okay. So for individuals, the exemption is only on physical work outside. But if you then tax immigrate, then you absolutely go out and you pay the exit tax. Now, if you then start working abroad, you're tax non-resident and you don't have to worry. You pay the exit taxes and thereafter you only pay tax in South Africa on what happens here, like rental income. But if you expand your business, we now have a lot of planning to do. Because first of all, at the moment, but on 1 March it may change, or we hope it's going to change, at the moment, only a company can expand and create a company or a branch outside of South Africa. A trust can't do that, and a closed corporation can't do that. If that company then expands and creates a branch in, say, England, then that income is first taxed in England, then taxed back in South Africa. So let's use America as a very interesting example because that is now changing when Biden comes in as president. In the Trump era, their company tax rate in most states was less than 18%. Okay. Now, our tax law says if you pay tax in the foreign country, so your subsidiary in America pays tax at 19%, like they do in England, then you would not pay tax in South Africa. You don't have to top up to 28. That 9% is saved. But because most of the tax rates in America is between 10 and 16%, because remember they have federal tax and state tax. If it's at 16%, then you have to come and top up by 12% in South Africa. Now, Biden has indicated that he's going to move the tax rates for corporates back to 30%. Then you don't have to top up because you're paying more on the other side than this side. So 2 important messages. You need Reserve Bank approval at the moment to expand. Secondly, you must look at whether you're in a high tax jurisdiction or whether there's treaty exemptions. Because there's, for example, a treaty law between us and Namibia that says Namibian properties, the income on that cannot be taxed in South Africa. The reason for that is that treaty is so old. I think it comes from 1991. Remember I said we went worldwide basis in 2001. So 91, SARS was not worried to say only Namibia can tax. So some treaties are very old that say only that country can tax. So very important, Reserve Bank approval, tax treaty, and then what we call controlled foreign company. And that's where the complication comes in. A controlled foreign company is when you or other South Africans with you together own 50 plus 1% or plus 1 of control. So if the South Africans is on control of that company, it's a CFC. then it is taxed back in South Africa. But there's this last little difficult one, and that's really the difficult one. Even if you only own 10% of the company, but you sit in South Africa and you run that international company from South Africa. So in the IT industry, we find it lots. And I see now suddenly in the social media space, because people are sitting in South Africa, the so-called digital nomads. Now, I don't know if you've done an article on digital nomads, but it's an interesting group of people, okay? They are truly digital. They do marketing. They get paid for doing marketing, and they're nomads, okay? If they just visit South Africa, no problem. I'm talking about a South African sitting here, and that company, even if it's incorporated in Delaware, which is so popular with the digital people, it's effectively managed from South Africa, and therefore it pays tax 100%, a full 28% tax in South Africa, because it's effectively managed in South Africa. So you can go in Delaware, it's not going to charge you tax. So you're going to escape the Biden's 30%, because that's only applicable to, say, California and Texas and so on. But the minute you're in Delaware, 0% tax. But then our tax laws say, but you're effectively managing it from South Africa. So it's a complex topic, can you see? And that's the things we have to plan before you leave or before you expand. So are you going to do a branch? Are you going to do a company? Are you going to create what we call a mirror structure? That would be an American trust with an American company below that. But remember, we have anti-avoidance rules with offshore trusts again. So there's so many issues. And then this dreaded exchange control rules, which hopefully will ease. So by 1 March, we think a lot of exchange control rules will just be easier. They're not going to disappear. Reporting will always be there. And I keep on telling clients, don't think because exchange control is being removed, we have total freedom. There's a thing called FATCA, and there's a thing called CRS. And that makes transactions reportable. So they're going to still monitor us. We must remember, just in the past, it was always you had to get approval beforehand. Now you just must make sure that you report post-event.
And now touching on the exchange control regulations and all of that, for people who are considering to immigrate, but now obviously they have a lot of assets within South Africa, going from investments, property, whatever. What kind of advice can you give to them in terms of selling their assets here and taking the money abroad, or what are the things that they need to consider and need to know about?
The first thing is, some of the banks are doing it already, but what is the difference between what we call KYC, know your client, in England and America, versus our FICA? Our FICA, people had to just say what bank accounts they had and what their address were. In KYC, this know your client, how the international world work, you had to justify your wealth. And now when they're switching off exchange control, SARS and the Reserve Bank is moving to the question, how did you get this money? So people must keep record. And if they're extremely wealthy and they don't have record, go and recreate yourself a background as how you got the money. Try and remember and try and find an old record where you sold this house and made 2 million rand, where you sold your company and you got 30 million rand, where you sold the inherited farm and you got 20 million rand divided by 4 children, each got 5 million. So source of wealth, how did you get that money, becomes extremely important, because it's not just the South African system. And now we speculating a little bit. The minister said in February 2020 in the budget speech, the 10 million cap at the moment is going to be a glass ceiling. The minute you want to go over it, you can go take out more, but you must show where the source comes from. So I just had someone who now last week in the 2021 year, while the cap is still 10 million, we were able to get a permission for 25 million because we showed the title deed change on the 23rd or 24th, just before Christmas. A property was sold in Cape Town for 25 million net profit. That was after the bond was paid and the attorneys was paid. Plus, I luckily had the liquidation and distribution account from the estate showing when his father died, father bequeathed it to him. Mom had the right to stay in the house until she died. She died in October last year, so he could sell. So we built a little story like that. The Reserve Bank allowed that. He used that money to apply for an American, they call it the EB-5 visa, the investor visa in America. You won't believe it, day after that, that was now yesterday, we get an email from America and said, in principle, your green card is approved, but you must please show and give us a source. And this is the attorneys that will, on behalf of the American government, do a research to verify the source of your. So suddenly all the documents I have to give to SARS, we are now giving to the American authorities. And theirs is more money laundering and anti-terrorism, because they don't want to, how trust is about immigrants and non-residents. So it may change in the Biden era, but I don't think they're going to walk away from this principle. Show us the source of money, because we don't want terrorist money or laundered money into our country. So it was very strange for me to be in Dubai and to see the amounts of cash. The people want to pay me in cash. And I'm saying, please, I don't even have a bank account here. I don't want cash. You have to do me an EFT or SWIFT, because I've put my bank account in South Africa. So there's jurisdictions that are still very cash driven, but most countries, if there's big wealth, rather have the EFT, because the other thing that we had with SARS is the last question they asked us, and this gentleman, is show us where the bank, the transfer from the attorney to your account. And the attorneys didn't like it, but they had to give us the EFT transaction, and we obviously had the client's bank account. So don't try and build a story that's not going to stand. And I just yesterday sent that to the attorneys in America, because I know they're probably going to ask me the same question. If you say it was a property transaction, show me how it left one bank and came into another bank. And luckily, with liquidation and distribution accounts, for those clients living outside the country, we had to, in this client's case, go back and we paid the attorney's firm, a law firm who did the estate, and they can go back to the master and they could get a copy of the liquidation and the distribution account. So I don't know how long back you can go, but the attorneys were able. There's a bit of a fee to it, but we got the liquidation and distribution account. And the other thing we had to do was to get the title deed, because what happens in these deceased estates, the transfer has taken place, but no one actually went and claimed the title deed, because my client sits in America. He was not worried to hold the title deed. Mom had just what we call usufructuary right. So she never needed the title deed to do anything, because she had this document to show she has a right to occupy, and the electricity account was in her name, the telephone account was in her name. So it doesn't matter, and it comes back to compliance and fixing your tax profile. Some of the documents will take time and a bit of money to source it, but at the end, we can clear your name. So yes, to come back, exchange control is lifting, but it's a capital monitoring flow, is what the Minister of Finance called it. And there was a circular last year, I think circular 2 of 2020 on the Reserve Bank page, that also tells us the principle of what is coming.
So I think the short story is almost, you cannot run away or hide forever. It will catch up on you at some point. So rather follow the correct and the straight and narrow path from the beginning, and make sure that all your things are correct and that you get the advice, so that you make the correct decisions, but that you also, do things correctly. But
so
I
now
also
can I tell you an interesting story just quickly on that? It's not just for people leaving. I had a very interesting call this morning. It's a divorce case in South Africa, and the wife claimed, her portion of the growth, because it's anti-natural, saying she has half the growth of hers. And then suddenly in their search for assets, they got a huge bank account, or stumbled on a huge bank account. And now the husband eventually had to come clean, and he won a lottery in South Africa, totally legal, tax-free. He won 12 million rand on the lottery, but he never told his wife, and that's many years back. So it's nearly 14 or 15 million rand lying there. So the other point I want to make is not just immigrants. It's like whether you get divorced. So when you do a status change, don't try and hide these things, because what happens is that the judge says, give me a bank certificate. What did the bank do? They listed the money market account that you didn't tell your wife about.
So that's a valid point. I know, Hugo, also what's happening a lot recently is that people would go abroad and they would not sell their primary residence in South Africa. But now maybe after a while, they decide now they rather want to stay on there, or they need the money. And now they are selling that property. But in South Africa, it used to be their primary residence. What will happen now with something like capital gains tax? Will they still consider that to be your primary residence, and you won't pay tax? or would the fact that you have basically left the country and you have maybe tenants in there or family or whoever, would that trigger capital gains tax then?
Yep. So definitely you can still claim, it's no longer your primary residence, let's get that clear. But you can claim a proportional part of that property or the gain as exempt. So remember, that's 2 million Rand, that's the primary residence exemption. So if you had the property, and I'm assuming you've only bought the property after 2001. So let's say you had the property for 12 years. So capital gains tax has been there for nearly 20 years. So you had it for 12 years, you've been out of the country 4 years, so you rented out 4 years. Then you can claim 8 divided by 12, so 2/3 of the 2 million exemption you can claim. There's a lot of restrictions, becomes a bit more complicated. If you're a doctor and you did your practice, or an accountant and you had your practice from home, then that 2 million can also be capped or restricted because you claim 15% of that as a business. Then they throw another 15% away because you had it as a business. The other thing people must remember is if they put it in the market, and this is now a lot of the planning we're doing at the moment, because there's the softer, it's a buyer's market, it seems, at the moment. So people are not getting their price and they don't want to drop, so they keep it in the market. They're also not getting a tenant. So one of the benefits of not having a tenant in your house is that if you then sell it after a year, you still can claim the 100% exemption because it stood empty. Because it was never used for commercial purposes. Okay. And any rent is commercial, whether it's claiming a rental deduction for tax purposes or whether there is a tenant in the house. But also very, very important, if you come to a point and you realize that you're not going to sell, then there's a point where you have to start renting out. Because in many tax treaties, there's a rule that says you will be deemed to be solely tax resident in the country where your permanent home is, not primary residence, your permanent home. Now let's take Dubai. In Dubai, if you have an Ajari lease agreement, you don't have to own it. It's a permanent home. So in the treaty between South Africa and the UAE, if you still have your South African house available to you, so if it's a holiday home or the farmhouse standing empty, and you can move into it any day, then it's still available to you, even if it's held by the trust. So sometimes it's just better to rent it out. The minute you have a long-term rental in or a market-related rental agreement, then it's not available to you and I can tax migrate you into the UAE and you get out of all the taxes. So very important. The house is a very interesting example to use because remember I said to you there's exit taxes to be paid. South African real estate, immovable property, title deed properties are not subject to the exit tax. The reason for that is, and that's the complication now, if you sell that property after you became tax non-resident, then we have a capital gains tax withholding tax. And many attorneys and estate agents, when you give them a tax number, they just assume you're tax resident. And that's just a tax number. It makes you a taxpayer. It does not state you are a resident. So if you have submitted to SARS a tax domicile or tax residency certificate from another country, the attorney have to withhold tax on that property. And remember the example I mentioned of the guy who had 25 million banked? The poor attorney is now fighting. Remember I said to you he was in America. So now that we applied for the money to go out, my client got the tick to say you can take your money out of the country. But SARS went to the attorney and said, I'm going to raise a penalty against you because you didn't withhold tax. Attorney went back and said, but the guy had a tax number in South Africa. And they said, no, he was not tax resident. So there's a penalty on the estate agent and the attorney for not withholding back. So on your family home, 3 things to remember. You can claim primary residence or portion thereof in the future. If you rent it out and you live in a treaty country, much better. If you have left South Africa and you're tax non-resident, then you have a withholding tax. So it's about 7.5% of selling price. And it's a complex formula. It must be sold for more than 2 million. Remember the threshold for primary residence is 2 million, so it must be above 2 million. And every owner must get 2 million of selling price. So if it's jointly owned by husband and wife, or they're married in community of property, then the selling price must be 4 million before the withholding tax apply. If you own it in your own name only, then the selling price 2 million and the withholding tax. So 7.5 million on selling price before you deducted bond costs and all those things. is very expensive. So it's really one of the biggest planning points. So people ask me, must they sell, must they not sell? And I said, it's not a tax decision. You must decide. If you're coming back, rent it out. Then people are emotional, say, but those people are going to destroy my house. You can claim the repairs from the taxman. But if you do not have a tenant in your house, I can't get you out of expat tax. So sometimes you must, if it's been a house that's in your family for a long time, I know it's emotional, but let's tax and emotions not take the better of financial management or asset management. It's very important that you just distance yourself, appoint an estate agent, and just emotionally switch off. It's not easy, but please do.
No, absolutely true. That is really interesting. And I think another hot topic at the moment, and I'm sure something that you also deal with a lot currently, in terms of your retirement savings and the tax impact, what's happening there?
Okay, very emotional topic. So first of all, it's not true that the exchange control rules and the expat rules is because of government want to take your pension fund to invest in SAA. Okay, it's absolutely not true. Okay, we can still take our retirement funds out of the country. All right. So on the 28th of February of this year, 2021, is the last day you can apply for formal immigration. So up till that day, you need to formally immigrate to get your retirement annuities out, as well as, and I'm not a financial advisor, so I'm going to give the best explanation I can. It's a preservation fund where you did withdraw money, or you did a once advance or once withdrawal benefit. Okay, so RAs and certain preservation funds, you need to financially immigrate. So the easiest that one of my colleagues told me, tell the client to ask his broker, in the old system, was it a so-called Section 14 Cap C transfer pension fund? Then you need formal immigration. As of 1 March, then you can take it out without doing formal immigration because it's being switched off. But now moving from a banking test, did you get a foreign permit or second passport? It now only says you must be 3 years tax non-resident. So you must be out of the country 3 or more years and have been tax resident in the other country. Now, I'm one of those lobbyists who's saying we are lobbying against it, not for the emotional reason, purely for the practical reasons behind it. My clients in Dubai can get a tax domicile from 2016. So we can show on the 1st of March, they have been tax non-resident in South Africa for 3 or more years. My clients in Panama and the Philippines can't. There's no tax treaty and there's no tax residency certificates in those countries. So it's not easy to show that you're tax non-resident. So they can still argue it, but the complication to show it is going to be more difficult. The other interesting thing is, remember, formal immigration was to move out of what we call the common monetary area. So if you move to Namibia, I could not formally immigrate you. You couldn't cash out your retirement annuities retiring in Namibia or Swaziland. From the 1st of March, because it's a tax test, and if you are living in Namibia or in Swaziland, or for that case, Lesotho, I can get your RAs out. So for some people, it's easier, and for other people, it's more difficult. Where does the practical issue, the planning issue, because I always like to speak about the planning, because I think a lot of people are listening to this too, because they're planning and they're considering it. At the moment, if you want to financially immigrate or formally immigrate, and you have your work visa for England that leads to an indefinite leave to remain, you can do a financial or formal immigration 60 days before you depart, provided you have the letter of grant to say you're getting it, and you have to have a ticket into England. And the Reserve Bank will allow you to go, and then the taxman didn't even do any tax residency test, and they will allow you to take the money out. They didn't worry if you were registered for tax in the UK or not. They just wanted to know that you formally immigrated, you have a so-called blocked account. So what happened is the young people, because, for example, people going to Portugal or Spain, they had to buy a property to get that visa. Now they've had that property for many years, and they've made some gains, unrealized gains on that Portuguese property. Now they must pay capital gains tax on it. They don't have the cash because they put all their cash into that property and the fees for the attorney. The way we then got the exit tax collected was to then actually sell the or cash in the RA, and we use the proceeds on the retirement annuity to pay the exit tax. That was our liquid cash. Now you have to wait 3 years. So the problem is, how are you going to pay that tax, the exit tax? Because you only can cash out your RA in 3 years' time. So there's a practical problem. We've brought it to Treasury's attention, and their fear is that people will leave the country just to cash out RAs. Now, that's a very difficult one. I can't think they can legislate against everybody because of a few stupid people who would hop in and out of South Africa just to cash out their RAs. Now, I must be honest, if someone wants to do something so stupid, we're not going to stop. Tax law is not going to stop people from doing stupid things. Okay? Because when you cash out an RA, it's not. That's why I so quickly say I'm not a financial advisor. I want letters from my clients saying they have considered the not estate planning, retirement planning impact on cashing out, because I can't give that advice. I can't sell you the new pension fund in the United Arab Emirates. I can't sell you a 401k in America. So I just want a letter or undertaking that you have replaced that. And that's just because of my professional standing. I have no obligation. The tax law has no obligation on me to do it. But it's just to safeguard me, because in America, they're very litigious. So before I cash out your RA for someone living in America, I want a letter that you are replacing it, or that you know how you will replace it. So not everybody is worried about that morality. Some people will just sell you the financial immigration so they can get the fee. So the one message to people are, if you are trapped in that you haven't been out 3 years or you're planning to go, then unfortunately you must make your decision before 1 March so that we can file your financial or formal immigration on or latest 28th of February. There's another one that I forgot earlier to mention. If you filed on the 28th of February 2021, then you must complete the fund transfer by 28th of February 2022. So have 1 year to complete your tax immigration and to cash out and get all the processes through at the fund manager level. So the physical rands must leave South Africa by the 28th of February 2022. So it's a bottleneck. I foresee a huge, huge bottleneck, but if clients are in that catch-22 position, do it. Then I'm saying do it. I'm not in favor of formal immigration. I think most people that have been out for so many years, all they need to do, as I said, do the VDP, get your tax records correct. On the 1st of March 2021, when the new law comes into being, you have been out 3 or more years, and then we can claim it back from SARS.
Sure, that is a mouthful. You need to just really get proper advice here.
Yes, yeah, absolutely.
Okay. I think the last question I want to ask you in today's session is just about for people who say, I don't want to immigrate, or I don't want to go work abroad. I just want to build up an offshore portfolio for whatever the reason might be. What kind of advice can you give there in terms of how can they build up an offshore portfolio that is tax efficient as well?
Well, okay. So the first question I would ask people is, what is your liquid cash that you want to take offshore? Again, I'm not a financial planner, but don't take everything that's offshore is normally my guidance. Make a balanced portfolio. Then if it's more than 10 million, I can already take more than 10 million out if I can show source of funds. From the 1st of March, it will be easier to take out more than 10 million rand. The next question is to ask, how diaspora is your family? Where are your children? Are you building the legacy for South African children, or are you building the legacy for foreign children? Reason for that. Just a small example. If you invest $60,000 in the American Stock Exchange, they're going to charge you 40% federal estate tax, FET, on everything above $60,000. And there's no rollover of estate duty between husband and wife. So it's a very popular, as you know, the shares there are doing good. Amazon is doing wonderful. Facebook is not too bad. And there's all these attractive shares. Then we have to look at what we call CITES tax, the tax in that country. We have to call an advisor from that country. So if your children are not in America, so that you can't use an American trust or whatever, you need to consider an offshore trust. But as a rule, offshore trust is expensive and not tax-friendly, because our rules in South Africa has anti-avoidance. Our tax act has anti-avoidance rules against an offshore trust. But if people tell me their children are living in Australia, then I would say, don't worry about a trust, because Australia has no estate duty. So it's interesting. We must look at where the children are before we make the final decision. And then the other thing that I see, because I normally try and take a financial advisor with me, the other question they normally ask is what you want to invest in. You want to be shares only, property only, because it's quite interesting how people differ. Because a lot of people then say, I want to buy a property in Portugal. So if my children want to go and live there, they can get the so-called golden visa. I have other clients who purely want to go for capital growth. Then they go into the American market because it's so, the returns there are so high. Mm-hmm. We have other clients that are saying to us, no, but if I invest adequate money in Australia, I can get an investor visa myself in Australia, but then it must be in shares on the Australian market. So there's a reason why it is then very restricted investments. So then we do the Reserve Bank application and we have to do the tax clearance. And remember, from 1 March, we'll have to show source of funds to SARS. It's not just you had the money in, because currently if you show a bank account for 90 days with that money in, or you show your share portfolio in South Africa, they'll allow you to take it out. The other part is that what do you, and for me, that's very important. What is your legacy planning? Do you want it to go to your surviving spouse? Or do you want to go for education for your children? And then the other reality we sit with in South Africa at the moment, which has an impact on us as tax planners, is are you a single or double? Let's call it modern family, because we have so many families where their father have a first wife that either divorced or passed away, and then a second wife with second children. And that becomes very important, because then you sometimes have to split your portfolios to make sure that this goes to the older children and this is kept in trust, because the children from the next marriage are very young. Mm-hmm. So I say the demographics of the family is becoming as important as the Reserve Bank application. So it comes back to that question. What is your intention with the legacy? Because that dictates where it goes to. If the father is quite happy to say that it's no longer he's worried when he dies, then they can inherit equally, then I don't worry. So the other interesting thing that I want to mention is in this SARB Reserve Bank Circular 1 of 2021, saying we can do loops. The other nice little hidden away gem in there is that if you now pass on and you're a South African and your children inherit your offshore assets, they no longer need permission to keep it there. The permission is automatic, provided it was what they call regulated funds. So you took it out legally. So the other important thing is keep that Reserve Bank approvals and keep that tax clearance certificates with your will, because now your children can leave that money abroad. So maybe it's not bad if they paid let's think about it. If you're an American, you paid 40% American estate duty on that. Then you don't have to pay South African estate duty. So if there's assets that you want to make available to your children, part of the estate planning is to say, that on which I'm going to pay American tax anyway, let me give that to the children. And the money in England, where I'm not going to pay inheritance tax on because of their spousal rollover rule equal to ours, I'll give to my wife. So, it's a lot of planning. Destination, citus tax, how will you like to manage your legacy?
Hugo, I want to thank you for sharing all of this information. It was really such valuable information that you have shared with us, and such important topics that we have discussed. I'm definitely going to invite you back in future so that we can discuss more things, because I think this is really important for people to know and to make the best financial decisions. I just want to emphasize once again that remember that whatever we are saying here is not financial advice. So we are sharing knowledge for you to get the knowledge, to get a better understanding, and then based on that, go to your financial advisor or tax consultant or whoever and make sure that you are making the best decisions for your personal situation. I'm also going to share Hugo's information if you want to get in touch with him, ask some questions, or ask him to assist you with whatever you are planning. But yes, I want to also encourage you, make sure that you are liking this video, that you are subscribing to the channel, entering the giveaway competition, but also in the comments fields, give some comments, ask some questions. We will get back to you if you have more questions, or also if you have more topics that you would like us to discuss in future. So Yihu, once again, thank you for your time and sharing so much of your wisdom and knowledge with us today. And then I want to thank the viewers for watching. I hope you have enjoyed it, and I will see you at the next Ronel Talks Money show.